Technological progress is still possible, or at least technological regress can be stopped. Welcome back again, everyone, to the Peterson Institute for International Economics. Thank you for your patience. I'm Adam Posen, president of the Peterson Institute, and this is the start, electricity gods allowing, of our macro week, as always coinciding with the Fund Bank annual meetings. And for the start of this week, we have the U.S. book launch of Patrick Honohan's new book, Currency, Credit, and Crisis, Central Banking in Ireland and Europe, and that's what we have you gathered here today for. Patrick Honohan, I'm proud to say, has been a non-resident senior fellow at PIIE, is former governor of the Central Bank of Ireland. He, of course, served in that role during the worst economic crisis of recent years in Europe and in Ireland. He was governor and a member of the Governing Council of the European Central Bank from September 2009 to November 2015. Patrick, of course, came to that job after a distinguished career both as an academic researcher and as a public servant, including in a leading role at the World Bank, where many of us in the Washington community got to know him and learned from him. And then, like the people of Ireland, we learned to rely on him during his service in the global financial crisis, and in particular, the crisis in Ireland. Patrick brings both analysis and a quiet passion for doing the right thing. He was joking before I stood up that some people say his book, Currency, Credit, and Crisis, doesn't have many surprises because he was so transparent when he was governor that he was telling them what they were doing while they were going, which I must admit is a refreshing change for a central banker. But I nonetheless commend the book to you. We saw early drafts as it went ahead, because it is one of those rare books that comes along that provides a combination of really good economics with really good practical reality and gives you not the personal dirt, but some of the personal insight that goes with making these choices. We've all been aware of the similar books written by Ben Bernanke, Tim Geithner, many others. I think both because of Patrick and because of the unique role he played with Ireland in this crisis, this book in particular deserves your attention. We're very fortunate to also have our colleague, Jacob Funk Kirkegaard, who's been affiliated with the Institute since 2002, hard to believe, who's now been through a couple European crises here. Jacob plays Janus for us. He's sort of a Northern European, but sort of reasonable. And so from that perspective, he will make a nice adjoining compliment to Patrick, who plays sort of a Southern European and sort of reasonable. And between the two of them, we'll hope to have lots of good reasoning. Before I call Patrick up here while the microphone still works, one last note. For those of you watching online and for those of you in Washington, this is the start, as I mentioned, of our big week. Tomorrow afternoon, we're proud to be hosting jointly with the Bernheim Center for Princeton and Marcus Brunnermeier a special mini conference on digital currencies, featuring a speech by Federal Reserve Board Governor Lael Brainerd, an appearance and commentary by Stefan Ingves, governor of the Swedish Riksbank, which of course has gone further in issuing digital currency than pretty much any other central bank, as well as a presentation by Professor Brunnermeier and comments from Hyun Shin of the BIS, Martin Wolf of the FT and the World, and our colleague Simon Potter at PIIE. On Thursday and Friday, we will be having the 5th biannual Rethinking Macroeconomic Policy Conference, of course, coordinated by Olivier Blanchard this year, jointly with Donnie Roderick of Harvard, Combating Inequality. And the list of luminaries for that event is too long to read, but it is on the PIIE website. But let us start out by learning from the mistakes and the victories of the past and the analysis that carries through from Patrick Honohan. Patrick.
Thanks very much, Adam. So of course I wrote this book to some extent to put down the first draft of history or the second draft of history, and learning from Winston Churchill that it's better to write it yourself if you want to get your picture out there. But I want to today maybe take a slightly wider perspective, which is also in the book, and draw on the aspects which are maybe of more general interest, because reflecting on what we had to do in Ireland and what happened in the euro area, I think it teaches us a lot about what central banks can do and what they should be doing. So I want to touch on three topics today. First of all, I'd like to talk a little bit, not about Ireland, but about the role of the ECB in managing the euro area crisis, which of course is a much bigger story than Ireland. In fact, Ireland, it's a chapter in the euro area crisis, but it's not the main feature. The second thing I want to talk about today is, what does the Irish case tell us about crisis management? That's something that I explore in the book, and I want to pick out a few lessons that I think are maybe not so well known, well understood. And finally, to the extent that we have time, I'll talk a little bit about how I begin to think about the modern central bank, where we have become used to a concept of central banks as being quite narrowly focused and aloof, and now there's a lot of advocacy about the intrusive central bank and how far one should go on that. So let me move on. The role of the ECB in managing the euro area crisis, where there are missed opportunities. I'm going to give you two key takeaways here. I'm going to suggest that the ECB, and indeed the euro area decision makers in general, delivered much less than they might have, because they failed to choose decisively between one of two available options to deal with a crisis like this. One of them being very tough, if you like, forcing write-downs where debt was unpayable, and the other very lax, where you say, oh, okay, so some people are in a bankrupt situation, but we will bail out. Either of those two approaches, if pushed systematically, could have sorted the euro area crisis, at least in the short run, much better than it was sorted. I'm not going to tell you which I think would have been better, but I'm going to argue that there were options. And then I'm going to talk about one of the reasons why, a more sort of micro-level reason why the ECB stumbled in this, and that's a doctrine that was developed at the ECB called the separation principle, which was a flawed analytical tool which led the ECB into policy errors. So why was the euro area crisis so severe? There are some people who still say, well, there wasn't really a euro area crisis. There were just a lot of crises, a few of which concentrated in the euro area. So that it was just bad luck that a few countries managed to, euro happened to have a concentration of a few countries. And if you look at, there's one chart which shows you the scale, the magnitude of the crisis. Things were more or less over by 2017, the recovery. So this shows you the employment change in all the European countries that I could really get reasonable data for. Peak to trough and peak to 2017. So the countries that had recovered, many countries over there on the right-hand side. You can see there's no blue part. They've fully recovered. They're ahead of the previous peak. And the point is that I want to emphasize here is that, okay, the first country on the left-hand side, the worst country, Greece, is in the euro area, but Latvia is now, but wasn't then. Spain, yes. Lithuania wasn't. Ireland, yes. Estonia wasn't. Croatia wasn't. So if you look across, you could possibly make a case for saying, well, there was a lot of problems in the European Union countries. They weren't in the euro area crisis. I actually don't think this misses a whole lot of the story. So I just want to point out to you that this argument can be made, but I don't think it has It has much traction. So then if it wasn't that, if there was something fundamental in the euro area, was it a question of design flaws or policy flaws, policy errors? And you can say there were design flaws. You can say, well, there can be pre-crisis flaws and post-crisis flaws. Pre-crisis flaws, the euro area delivered low interest rates even to countries that needed higher interest rates. And it's certainly true that there was the intended and expected convergence of interest rates, the euro area. You can see them all converging down to almost no difference between max and min interest rates from 99 until the crisis started to break. Still, interest rates were low outside the euro area as well. It was very easy for countries such as Iceland, Latvia to access funds for their boom and expansion. Post-crisis, you could say, well, the design flaw was that countries couldn't devalue themselves out of the crisis. But this is not a bug. This is a feature of the system, as everybody in the room knows. It was a commitment device. Now, Ulysses wanted to hear the sirens, but he didn't want to get lured into whatever the sirens did to people who were shipwrecked in their territory. So we know that he had his rowers close their ears and he tied himself to the mast. That's a commitment device. I want to hear the sirens, but I'm not going to let myself in a situation where I'm ever going to land there. But if the boat had sprung a leak or hit a rock, then this commitment device can lead to trouble. And I think this is certainly a design flaw issue. Yes, it was deliberate, but the countries that chose the commitment device should have behaved themselves in such a way that they weren't going to get drowned. Policy errors, pre-crisis, certainly. There was a degree of complacence. The governments had their eye off the ball. Imbalances grew rapidly. But the bit I want to emphasize here is the post-crisis policy errors. And this ambivalence, or if you like, indecisiveness between a hard and soft approach. So specifically, the way the euro area dealt with the Greek debt by providing loan finance that transferred debt claims from private to public ownership, thereby making subsequent restructurings of Greek debt a matter poisoning intergovernmental relations. This was a middle ground. We're not, the Greeks are going to have to pay, but we don't want anybody to suffer any defaults in the private sector, so we transfer into the public sector. So this is a problem, a middle course problem that's still unresolved. And actually, if you think specifically about the question of bank-related debt, especially early on in the crisis, 2008, a lot of banks teetering up on the edge. There was this, in September 2008, decision by high decision makers in Europe. There's going to be no bail-in, but no collective bailout. Again, a middle course. You can't bail in the private sector, but Europe's financial might isn't going to be brought to bear on this issue. Each individual country has to deal with the consequences of no bail-in. So this was a highly problematic middle road combination. There were no adverse consequences for incautious investors, and national governments were placed under financial pressure, several of which had later buckled and had to be supported by IMF loans. Now, pressure on national governments could have been less if quantitative easing had been introduced when the US did so. So that was November 2008, quantitative easing started. But the ECB didn't. Why did the ECB not do quantitative easing there? Well, one reason was that the ECB thought it was actually doing enough. The crisis, it had lent enormous sums of money to the banking sector. And in addition, there was a sort of lurking fear that getting into QE would be a big step towards the transfer union, which had been ruled out as a condition of Germany and other creditor countries getting into this euro area arrangement. Even though at that stage, November 2008, Italy and Portugal were AA countries, Ireland and Spain were AAA countries, and even Greece was an A-rated country until December 2009. So still there was that lingering idea, but mainly it was the ECB thought, we are doing a lot. We were the first to provide huge amounts of funding. And this was backed up by an analytical approach, a sort of novel analytical approach. There are many separation principles in economics and finance. This was a new separation principle. We will deal with the liquidity squeeze in banking with non-standard measures, short-term liquidity measures. But as far as the macro situation, inflation control is concerned, we will continue to use interest rates for that. So old-fashioned central banking, interest rates up or down to keep the inflation steady, stabilize the economy. Problem in the banking sector, that we'll only use non-standard measures for that. This was the separation principle. And it can be documented systematically. There are speech after speech by officials of the ECB in 2008, 2009, getting a little bit less pronounced in 2010, and by 2011 or 12, it's gone away altogether. Because of that, the QE was seen, it's non-standard, therefore no need for it in 2009, because we've done enough to stabilize the banks in liquidity terms. It's not only QE that was stifled and delayed by the separation principle, but the separation principle gave produced another problem, the 2011 interest rate increases. Interest rates were increased by two 25 basis point steps in early 2011, when it was clear that the crisis wasn't over. So why would they do that? Well, because interest rates have nothing to do with the crisis. We have non-standard measures for the crisis. Interest rates are for the macro. And what's happening to the macro? Inflation is going above 2%. It's heading to 3%. We don't know where it will go after that. And it actually did reach 3% in late 2011, which doesn't seem like a very high rate of interest to some people, but to other people, it seems like a very high rate indeed. So that idea of the separation principle, that you do not use the full range of your tools for the overall macroeconomic situation, led to that error. Eventually, gradually, when the market fears extended to Italian government debt, to Spanish and even French banks, and there's a sense that no one is in charge, crisis is deepening, need to use the full set of tools began to be realized. And you get the OMT program, and then subsequently, when the OMT is in place, not used, but in place, ready as a kind of backstop, if I may use that term, we'll try other things. We'll try other things to get inflation back up again, because now it's gone down too low. Could we use negative rates? Yes, if we give the market enough notice, they can adjust. Could we use forward guidance? Yes, and that did achieve decoupling from the US taper tantrum and return to a more normal monetary situation in the US. Could we buy private bonds? Yes, but the market is very thin. Could we provide incentives for lending through our collateral programs? Yes, but that had limited impact. So eventually, step by step, the ECB finally peeled away all the possible objections to using QE. Inflation still way below target, and the door was open to finally using QE because it was clear that a measure of that type was needed. Okay. My second topic is crisis management lessons from the Irish case. So let me move quickly through this. And the first thing that people want to talk about when they talk about the Irish case is, why did you bail out the banks? So first of all, we have the dates right here, so I don't have to accept any responsibility for this because this was all a year before my time. But it is very curious how resolution policy and bail-in, bail-out policy has flip-flopped through not only Europe, but especially in Europe, through this crisis. Northern Rock, at first they don't get ELA, then they get ELA. Lehman's no, they're not going to get ELA. Ireland, Irish banks, September 2008, no ELA, no, the government should give a guarantee instead, and subsequently gave huge amounts of ELA, bigger than anywhere else. Cyprus, at first, yes, give lots of ELA, and then, oh, wait a minute, no, that's too much, no ELA. So there's an enormous amount of flip-flopping on ELA, flip-flopping on bail-in and bail-out. Again, Lehman's started with, and so forth. So what was the cost to Ireland of guaranteeing basically all of the bank's liabilities? There were a few long-term subordinated debts, perpetual subordinated debt that weren't guaranteed. The problem, I have a chart. Well, this chart I didn't spend time on. This is the one that shows you why Ireland got into the trouble with the banks. This is the chart that shows that the banks recklessly increased the loan-to-value rates, even as prices went higher and higher. The banks said, no, it's okay. We're going to lend on even more liberal terms through 2005, 2006. And of course, they got into trouble. But what's the cost? The tendency to think that, well, the Irish government sucked it all up and paid for all of the losses in the banking system. That's actually not the case. There were a lot of recoveries. There was a lot of pushing costs onto other. First of all, the shareholders of the Irish banks ended up paying almost as much as the Irish government, quite rightly so. The shareholders of the foreign banks, it wasn't just Irish banks that got caught up in the Irish property bubble. The foreign-owned banks, British banks, Danish banks, Belgian banks, etc. So roughly speaking, they injected about the same amount of money again. Some of the subordinated debt holders that had been guaranteed, well, the guarantee ran out and they were stiffed to the extent of 14 billion. That government figure, so the government paid about a third of the net cost. They laid out a lot more, but they recovered some. That's a lot of money. It's about 25% of gross national income, at least gross national income at the trough of the crisis. It's big, but also it's only part of the austerity. The tendency to blame the bank bailout for the austerity. It's important to recognize it's big, but it's not the austerity required to rebalance the public finances was substantially larger. Yes, in 2010, huge amounts were laid out and then stabilized. The blue line shows you basically the amount of austerity relative to the pre-crisis budget. The whole budget had to be adjusted. Once it was adjusted, it made savings year in, year out. And so the banking part is relatively small. It's interesting to compare Ireland and Iceland in this situation because Iceland's banking system collapsed even more comprehensively than that of Ireland at the end of 2008. And in that case, the Icelandic government did not guarantee our bailout. They divided, they made some fairly ex post arrangements, deciding not to protect the foreign depositors, the foreign bondholders, but they did protect the domestic depositors of the Icelandic banking system. So they laid out quite a lot of money at that time, but then they got recoveries as well. And actually, in the end, including fairly interesting footwork by the Icelandic authorities in 2000, I guess it was 16 and 17, negotiations with the hedge funds who now held the bonds that were claims on the estates of the failed banks, but were caught in behind Icelandic exchange controls. Those foreign hedge funds agreed to pay a stability contribution. How could you refuse to pay a stability contribution? A very substantial implicit tax of I think about 40%. In the end, the Icelandic government came out basically, it was a wash. They didn't pay anything in the end for the bank creditors. Of course, there was a downturn, there were huge losses to Iceland. But let's see how the Icelandic economy evolved in the crisis and how it differed from Iceland. because this is the answer to the question, what difference did it make to Ireland being in the euro area? I think this is the next chart. The next chart just shows you how much central bank funding was used to, if you like, to honor that guarantee. Because otherwise the creditors of the banks would have said, well, we want our money back. And the Irish government would have said, yeah, we said we would give it to you, but we don't actually have any. But the ECB had lots of money, and the Central Bank of Ireland was able to draw on that, and huge amounts of central bank financing. But the economies, the economy of Ireland and the economy of Iceland, how did the evolution of those economies differ after the crisis? And this is clearly a currency union effect. The green, of course, is Ireland. And it shows you from 2000 up until 2007, Ireland and Iceland, real wages it's a boom. They're going up fine. And then the crisis hits, and Iceland, unsurprisingly, exchange rate collapses. Their real wages don't fall by as much, but they fall quite a lot. And so we get a type of adjustment led by a fall in real wages, which of course makes Icelandic labor much more competitive, get a rapid recovery, or more rapid recovery in output and activity, and then the real wages start to come back. The Irish case, of course, prices fall in Ireland in the crisis. The exchange rate doesn't, but prices fall. Real wages actually rise in the first 18 months or so after the crisis, and then gradually the situation is brought under control. That means that different people, different types of people were hit in the two countries. If you managed to hold on to your job, you did okay in Ireland. If you managed to hold on to your job in Iceland, you still did better than losing your job, but you did take a big wage cut on average. So that's an effect of the currency union. Why did the recovery stick in Ireland? Why did the Irish policymakers manage to persuade the general population without much by way of demonstrations and complaints and so forth? Well, first of all, the politicians. Age. The senior politicians, sort of four politicians that had operated a kind of war cabinet, older guys. No real interest or desire or expectation that they would be re-elected. Not only that, they recalled the 1980s, a different type of crisis, a fiscal crisis of the 1980s. They knew that delay and prevarication was not going to make things happen quickly. So they wanted to move quickly and take the medicine that they knew would be needed. And also, they had an eye on the history books. That's all they could look forward to. And the public. Why did the public put up with this? Well, let me tell you one statistic. If we take the number of Irish-born people who live outside of Ireland and express it as a proportion of the Irish-born people who live in Ireland, the number is 18%. It's a high percentage. It is the highest percentage of any country in the OECD area. And what does that mean? It means that Irish people, both those people and the people, their relatives and the people who know them, they know how the world economy works, sort of. They don't know indeed, they don't know as much as people in this room know about it, but they know. They might not like capitalism, but they know the consequences of not tightening the belts when the belts need to be tightened. And so they hated it. And they hated in particular certain ways that things were done, should have been done in different ways, but they knew that this was the only thing that was going to work. I think I have used up almost all my time without telling you what the role of the central bank should be in the modern economy. So let me just, I have to put that in. That's up-to-date chart of the numbers at work because it's gone back, just back above the peak now in this year. Keynes said, Treatise on Money, 1930. Today, we have involved ourselves in a colossal muddle, having blundered in the control of a delicate machine, the working of which we do not understand. You know, I think he might say exactly the same thing looking at central banking at the moment. We're in a time of transition in central banking. Some people think we would go back to central banking as we knew it in the 1990s and 2000s. Some people think it's at the verge of something new. There are a number of things to say about central banking from the experience of the last 20 years. Some things are about the classical central bank. Oh yes, I'm not going to talk about that chart. The classical central bank, some things about, in other words, mistakes made about interest rate policy and so on and so forth, the traditional role of the central bank merely looking at inflation stabilization. There are some things to be said about the role of the central bank as the state's main bank. That's sort of obvious in many countries, but it's especially complicated in the euro area, where the central bank is really part of a euro system central bank. But it has national responsibilities as well. There are certain tasks of each national central bank which are not devolved from a European legislation. And at the end of the day, there can be conflicts between the state, interests of the state, and the interests of the other members of the euro system. And so there's a very delicate role for the national central bank in such a context. The assertive central banks. Central banks have to be a lot more assertive now. I talk about the role of the central bank in conduct, which is a task. Not all central banks have that task, financial conduct. And there are very interesting cases in Ireland of misbehavior of financial institutions, banks and other financial institutions. And the role of the National Central Bank in macroprudential measures, loan-to-value ceilings, these other non-monetary policy instruments for stabilizing the financial sector. And finally, but I won't talk about that today, the expansive central banks. Some central banks think they should be doing more. They should be doing helicopter money to reduce inequality. They think they should be financing measures for climate change. And, to some extent, they're right, but that's a topic that would need to be expanded on for another day. There's a picture of the cover of the book, but it exceeded my baggage allowance.
Well, thank you, Patrick. It's a pleasure, first of all, to offer comments on this book. I should say from the start that, at least for someone with my reading habits, the concept of the sort of warrior scholar, namely the typically multi-star general that also just happens to have a PhD in international relations or history, etc., and typically writes a sort of quasi-memoir elucidating the particular trench warfare that it's typically a he, was involved in, but at the same time places it in the broader regional historical context is always a pleasure to read. And this is actually very much what this book is like. Because it's clearly a book that is centered on the issues surrounding the Irish crisis, but it is also a book that very clearly places that particular historical set of events in the longer historical context of Irish economic growth and the anchoring of Ireland first sort of in the historical British Isles and then obviously in Europe, as Patrick just mentioned. But more importantly, it's really 4 for the price of 1. The book has 4 distinct parts. The first is about the currency regime, longer-term history of Ireland. Then it talks a lot about the second role of the Irish bank, a central bank, not least as a banking regulator as well. Then it has a large section on the Irish crisis itself. And then finally, it takes a step or 2 back and offers some broader comments about the euro area integration and Ireland's boom and bust history. And I would certainly also immediately take issue with Patrick's description of the book as a book that doesn't actually offer much new insights or details, that it was all known in advance. As someone, I admit that I didn't know nearly enough Irish history, but I certainly would count myself as one of those who read a reasonable amount of Euro area commentary from sort of 2009 onwards. But having read this book, I now know the precise circumstances and the identity of the, by the way, still sitting very senior European official that broached the issue or linked the Irish corporate tax rate with the circumstances of the Irish bailout. I certainly did not know that beforehand, Patrick. So this is a book that you can read, and I'm not going to tell you the name of the person involved. You'll have to buy the book to find out. But this is a book that has an enormous amount of detail, and you should be commended for putting it in there, Patrick, in such an accessible way. But quickly running through the main themes of the book. Basically, the first part, as I said, is a broader description of the choice of currency regimes that faces a small open economy. And it really takes the view of take it from someone who knows. In this case, a senior Irish policymaker in a country that has tried it all. As you can see, there are at least 4 specific types of currency arrangements that Ireland has had within the living memory of Patrick and other senior policymakers. And, his comment his verdict is pretty clear. Doesn't matter so much if you get the other policies right. And I would say that coming from an institution here at the Peterson Institute where, in light of this answer at least, a disproportionate amount of time and analysis is spent on deciding whether fixed or floating is good or bad, this is a somewhat controversial even verdict. Patrick also finishes up by saying that fundamentally, Ireland might have done as good and as bad whether it was inside or outside the euro area. He already touched upon the comparison with Iceland, which may be a relatively extreme example, where I would argue that the chart shows that there were significant benefits of being in the currency area. But I would say that there is one element where I think the euro area membership is quite important, and it is also one of the aspects of the Irish economic history and model that isn't touched upon in the book, which of course concerns the role of foreign direct investment in Ireland. Because I would fundamentally, now we can discuss whether or not the role of foreign direct investment and associated issues are very important for Irish economic growth. I would contend that they probably are. And I would contend that it had probably been difficult to achieve that outside the euro. This is a chart that just shows you net income of inward FDI by sector. And as you can see, Ireland has been very successful at that. Not the only one. There are many in the competition inside the euro area from Luxembourg and the Netherlands as well, but certainly in the manufacturing sector. But this is one area that the book doesn't describe. And since this is also an issue that is probably not going to be less controversial going forward, there are new proposals at the OECD. So I would encourage, here is a next topic for your next book, Patrick. But moving on to what it has to say about central banking, the financial sector, and banking regulation. I think the sources in the books goes into a lot of detail about this. The sources of the financial boom is relatively well established, right? You had huge private wholesale capital inflows into Ireland during the euro area. You had low real interest rates, as Patrick mentioned, and then you had this shift, and the book goes into a lot of detail about this, but you basically shifted from a sort of sound to a more speculative banking model, and it was associated with relatively lax risk management and also supervisory failure, basically. But I guess I would say that a lot of these 3 things could also be said for most of the other euro area peripheral countries. And if you look at why things went wrong in different euro area peripheral countries, there were only really 2 countries in the euro area that had the sort of traditional sort of real estate construction boom bust that Ireland and Spain, to a certain extent, also had. This feature was less present in Greece, Portugal, and Cyprus, where there were other reasons for it. And I would say that, and this is partly my own biases as someone who writes a lot about immigration and demographics and these kinds of things, but if you take a look at just the raw population numbers of the euro area during the euro era, you will see that there are 2 countries that really pre-crisis had what in retrospect I would contend were pro-cyclical population growth rates. They were obviously Ireland and Spain. So when you think about why is it that banks began to lend so lavishly and as Patrick said, with loan-to-value ratios that in retrospect made no sense. But if you had had a period where actually population growth was about 2% a year, that probably maybe was less crazy than it looked in retrospect. And particularly when you have this kind of population growth, a construction and jobs boom, you tend to get the kind of very pro-cyclical fiscal policies that the book describes and that Patrick mentioned. I mean, there's a reason why both Spain and Ireland had debt to GDP ratios in 2008 of only 30 to 40% of GDP. And associated credit ratings. It was because of this development, which was driven, I would contend, in these two countries by population numbers that obviously were not sustainable. So I would say that if you think about this going forward, when you have these kinds of population numbers, it's probably a number that supervisors and fiscal control people should also pay a little bit attention to, because it tends to feed into a general pro-cyclicality. Turning to the crisis, the main conclusions of the book concerning the program, Patrick has already alluded to it, and I won't spend much time because I largely agree with what it says. I mean, the whole point here was that this was a program that worked in the way that it should. It alleviated stress. It actually allowed, as Patrick mentioned, austerity to be drawn out. Crucially, national sovereignty isn't lost with the program. It's lost when you lose market access provided, and I think the book makes that important provision that the program country can deliver this decisiveness and determination and homegrown detail, as the book describes. And obviously, by implication, it is clear that there are other members of the euro area in which this last feature was less present, and therefore they have fared noticeably worse during their programs than Ireland did. So where it comes out, perhaps I might say, for someone who was directly involved in the negotiations, not too surprising, but I will say that it is a verdict that I fully share, and that fundamentally this was about as good as Ireland could have hoped for. But I would actually even go a little further and perhaps press the book's conclusion further than what Patrick does. Because I mean, I basically take the view that Ireland did not get a rough deal at all in the end. It is true, and the book describes this, that initially interest rates for the first program in Ireland were very high and quite possibly unsustainably so. But it is also, in my opinion, true that it didn't last very long. Because when the ESM term sheet was negotiated and published 3 months or 3.5 months after the Irish program, it had provisions that, in my opinion, clearly, that made it pretty clear that these high initial interest rates would be adjusted, provided that the program was adhered to. So the bottom line there for me is that, yes, it would have been ideal if this was not to happen, but really to quip 3 months into a 3-year program that the initial interest rates were way too high, I'm not sure that I would say that that's not, in retrospect, for me at least, a major deficiency with the initial program design. Because, fundamentally, as Patrick and the book lays out, this was corrected. And even if it is true that probably the ECB initially cared more about ELA and the Commission was really more worried about contagion, reductions in the interest rates were very significant. Maturity extensions were very significant. And it was maintained to this day despite early repayments. And obviously there was a, shall we say, creative solution found to the promissory notes for the IBRC as well. So my bottom line is probably that Ireland actually got a pretty decent deal in the end. Then finally, taking a little stock and looking ahead. The book has a section at the end that looks at the still deficiency of the banking union, and basically makes the argument that it's incomplete without EDIS and further reductions in domestic sovereign bond holdings. I fully agree with that. And Patrick discussed this also during his remarks just now, that there needs to be, it would have been better in retrospect during the crisis if there had been a sort of either hard or soft approach taken. That may have been true in retrospect during the crisis, but I mean, I think the political obstacles are well known. But I would certainly say that looking forward at the interest rates that the ESM is currently charging Ireland and will, if you believe forward rates, etc., be charging potential program countries in the euro area for the foreseeable future, I would say that the third way, which is basically the one that's being pursued right now, looks pretty attractive to me as well. So looking forward, I'm not sure that you need to really go to a hard and soft approach. And then finally, coming to this point that the book said, well, what should central banks be characterized by? I think this is the key quote. That one, of course, the central bank needs to pursue an attainable goal consistent with a legal mandate. Now, we can, of course, get into an immediately discussion about whether close to but 2% of inflation is an attainable goal right now. But at the same time, of course, central banks, as was written here, must have respect for the limitations of their mandates, and they cannot arrogate to themselves the role of government. But they have to work with government, which certainly means that, and I think you said it yourself just now, Patrick, that this is not a book that advocates ECB monetary actions much beyond what is currently on the books. Because if you did so, you would clearly get into explicitly fiscal type or functionally equivalent of fiscal policy for which the ECB has no mandate. But on that note, thank you very much.
Ooh, microphone. Thank you. Thank you, Patrick. Thank you, Jacob. As you can see, and I love Jacob's image of the warrior in reflection. Ireland is omnia divisa est in partes dues. It's a great image of a great book, and I appreciate the discussion. Patrick, anything particular you want to respond to and brought up by Jacob's comments?
The only thing I'd like to add was why did Ireland's boom get so far out of hand? And I like Robert Schiller's idea, which he has reiterated more recently, that there's a narrative catches hold. Ireland had a strong recovery after the crisis of the 1980s. It broke through all previous barriers and continued to grow in a sustainable way based on export-led growth and based on moving more population into the productive sector, female participation, return migrants, reduction in unemployment. And that was a move right out to the production frontier around 2000, 2001. But then, like Roadrunner, I think it is, in the cartoons, it kept on running and supported by this property boom. Why do they think that? Well, they said, we've had growth rates of 5, 6, 7%, often distorted by the presence of the multinational companies, giving you very misleading readouts of what GDP was doing. We can continue this forever. We are the Singapore of Europe, and as you say, inward migration. Where does it have to stop? Ireland is a relatively underpopulated country. So people had visions of an ever-ending growth, which sustained a bank going out saying, we'd like to, borrow money from wholesale markets, or even take some subordinated debt in. They were paying some tiny premiums for that because the rest of the world said, yeah, Ireland, let's see, oh no, AAA, and they're growing very well. So that narrative built on itself in a way that Iceland did also, and some of the Latvia, some of the recovering Eastern European countries.
What do you think, Patrick, of Jacob's characterization about the Ireland having been through the multiple exchange rate regimes and ultimately only the policy that matters? I mean, he took a quote from your book. Just for the record, Mark Noland and I, in the last 7-8 years here at the Peterson Institute, have killed the study of comparative regimes. So don't let Jacob's nostalgia confuse people. But in your view, I mean, is that a takeaway you want people to have?
It is. I've been a fixed exchange rate person, generally speaking, but not in a doctrinaire way. And in fact, gradually, I have seen fixed exchange rates as being more fragile than constructive. The euro we imagined as being something in a whole different league. And I think it was in a whole different league. And if it hadn't been embedded in the legal systems of each country and not just a fixed exchange rate arrangement, it would not have survived. Yeah. It did survive that massive shock. So it was in a different league. But I think fixed exchange rate regimes are fragile institutions, so they deliver goods, but then there are risks going with them. So that balances with the advantages and disadvantages of the flexible.
Thank you. Jacob, just one clarifying question on your presentation, which I thought was terrific. The chart about multinational investment, the income on inward FDI, you characterize it as showing that Ireland benefited a lot by being in the euro area. But I think for those of us who don't follow this, we think of Ireland as having pursued a set of tax and competitiveness policies that attracted investment from all over. Why do we interpret that chart as being something to do with its euro membership?
No, I mean, there's no doubt that this precedes, 1999. So I mean, it's for me, it's more a matter of the success of it. Okay. I think it would have been difficult to sustain the scale without having been anchored in the euro area.
Because I'm just trying to draw you out. I'm not criticizing it. So because there would have been such large capital inflows that the Irish pound would have then gotten overvalued, because people would have lost interest in Ireland?
No, I think it's as much a matter of the attractiveness of, because as the chart also shows, it's not like Ireland is the only country in the euro area that engages in, shall we say, tax optimization strategies, right? I mean, Luxembourg and the Netherlands are right up there as well. So therefore, I think, in addition to being common law, English speaking, and therefore very attractive to American firms, I think that being in the euro provided the sort of basis for this to happen. Because otherwise, I think many multinationals would have probably located in, say, Luxembourg or particularly the Netherlands.
I don't recognize that, actually. I think certainly the European Union crucial, and I don't dispute in any way the role of the tax rates and the tax regimes in attracting those companies. For years and years, I used to say, well, where are these industrial policy linkages from the multinationals coming in? They've been coming in since the 1960s. Where are the linkages? And actually, the linkages did actually start and have started really in the last 10 or 15 years. So it's not just a multinational segment, which is an enclave and has nothing to do with the rest of the economy. It is inherent in the, membership of the European Union is an essential ingredient. I don't think the euro is. And if you look at those multinational companies, very many, if not most of them, are US companies. Much of the transactions that they do are with the United Kingdom, which is not in the euro area, or with Switzerland in the case of pharmaceutical companies. So I'm not sure there's a currency thing in it.
A final question before I open it up to our audience that's present here. As Jacob rightly says, you in your book are talking about central banking in general for Europe, for small open economies. Not so much for market commentary, but we seem to have reached a very real turning point at the ECB, that there was such obvious public dissent from the last decision taken, and that this decision to do more with monetary policy, despite the divisions, came at the same time that outgoing President Draghi said, well, we've pretty much reached the limit. How do you see things setting up for incoming President Lagarde, not so much her personally, but just going forward? Has ECB monetary policy reached its limit, both functionally or just in terms of support within the Council?
Well, I think it's really a question more of communication than of actual changes. And I think what we've seen here is, yes, this was a transitional period where obviously the interest rate and the inflation rate wasn't coming up. And I think I'm just reading it into what Mario Draghi wanted to set the scene for the next president, to say, look, I'm making it clear that there is a majority on the governing council for doing more. So does it make that much difference to have 10 extra basis points, buying relatively small amounts of it? Probably not that much difference in practice, but it opens the door to that in the future and says there is a majority in the council for this, but it has had the effect of bringing out even more into the open, and that has been a progressive opening out of communication from the ECB. ECB is in some ways very transparent, but has always from the start tried to be monolithic, one voice. And gradually those the voices have become more discordant, as you say, in recent weeks, very much so, but it's not the first time. But I think that in future it will be a challenge for Christine Lagarde to manage that evolving communication situation, because we're going to see that that different voices will be heard. And different voices are heard in the US, in the UK, in Sweden. That is conventional,
Yep.
but there are difficulties for some of the members of the Governing Council in terms of their communication with their domestic audiences. They have been able to say, this is a group, we arrive at consensus discussions. Don't ask me what I thought. At some point, they're going to be asked, yeah, what did each of you say? That will come at some stage, and it's going to be difficult.
Thank you. Let me open it up. This is on the record. We have a traveling mic in Jessica's hand up front. We have a standing mic in back. Please feel free to come up and ask a question or signal. When recognized, please identify yourself before asking your question. Anyone? Yeah, please.
Liam Abril, quick question, Pat, given all of your experience, any advice for the current occupant of your position in light of what may be happening in the context of Brexit?
Well, he was reporting in the Dublin newspapers this morning that everything is ready, all preparations have been made, so kudos to his immediate predecessor, who was my successor. So everything seems to be steady as you go. Brexit is not good for Ireland. We don't know what the deal that's being negotiated today is, but it looks like a very second best for Ireland. The May-Barnier deal, which would have kept Britain sort of within the customs union and would have streamlined everything. No tariffs between Ireland and Britain, no transport logistical problems of shipping your trucks right through the larger island on the way to the continent. That would have been the best deal for Ireland. The crucial part about what's talked about now, if you like, border down the Irish Sea, would be to de-emphasize the border on the island of Ireland. That's crucial for security and for identity issues and deep political issues. That looks like being preserved. The financial sector, there's no particular disturbance coming from the financial sector. There's been a flood of applications over the last number of years from smaller financial sector firms wanting to coming into Dublin, and companies that were there already ramping up, Barclays and Citi and JP Morgan, and even Bank of America, Merrill Lynch, who decided they worked out capital ratios and all that. Oh no, we're going to move back to London. They pulled all their balance sheet back to London, and now they've said, well, actually, no, want it back to Dublin. So there's been a lot of work for the central bank managing that, and it's not a soft touch regulator, and there are probably some people who are moving from different jurisdictions saying, oh, well, let's try the Irish, and probably got rebuffed, but no, it's a serious regulator now.
Another question, please.
John Lipsky from SICE. Forgive me for asking the obvious. The first year of the Greek crisis, the EU actively kept the IMF at bay and eventually brought in the IMF. Initially, there was no EFSF and no ESM. Two questions. One, could you characterize what you thought the addition of the IMF as part of the Troika meant to working out the Irish situation? And secondly, looking forward, does the new institutions that exist mean that in the future there shouldn't be or wouldn't be a need for the IMF to get involved in a euro area country again?
Well, certainly as of 2010, and I said so at the time, in the relevant circles, the IMF were the only people who had the experience and knowledge to deliver a program quickly, to know what will work and what might work. One of the slides that I didn't have time to show showed something about the Irish macroeconomic projections, which was, because the IMF doesn't always get it right, but in the case of Ireland, the projections, the macroeconomic projections, were sufficiently close to what actually happened to make the thing viable. Because if you've got your macro projections wrong, everything's going to derail. They didn't. Only the IMF could deliver that sort of quality. They also came in and said, look, your programs, your economic programs are okay, your economy doesn't need to be restructured. There's just a few things that went wrong, but they went wrong big. So they didn't, they were able to see this is okay. A lot of what you're doing is okay. We can just go with it. Actually, I would have liked to see them use, or like to see Ireland use the opportunity more to change the remaining structural features that could be improved. The legal system, the medical system, various structural things that are wrong. But the IMF were the only people who could deliver at the time. Could Europe itself now deliver? Well, it's 10 years of experience with crisis packages. The blocks of money are there, and the blocks of money are no longer with the IMF. As long as Europe is not a federal union, it's not obvious that it can claim to have all the tools to deal with these problems internally. The individual countries are individual members of the IMF. They should have access to IMF expertise and so forth. So, but then my first job was at the IMF, so have that old loyalty.
Okay, any other questions or comments for either Patrick or Jacob? Yeah.
So Ted Truman here at the Institute. Maybe both want to comment on this. So you start basically with the crisis, right? And you spend very little time on the pre, except for the boom bust aspect of the pre-crisis. But there was, and you are well aware that I've written something about this stuff too, not nearly as scholarly a piece. So what about the period sort of from 2006 to 2009 and how the euro was operating? Well, you say in that period too, you would go back and say you were dealing with the separation principle, basically, and that's what led to the fact that a lot of money was put out after the Paribas announcement, right? And that was part of your separation principle. And then a year later, they raised interest rates. So is that essentially the same part of the story that you would say, and that therefore, if you had been running things and you could rerun history, you would have done things differently starting as early as 2007.
Yeah, I mean, with hindsight, yeah. And I think what it reflects is that although even, in August 2007, ECB and the other central bank realized there was something very unusual happening. First of all, they thought this is an American problem. It has spilt over to some European small German banks that didn't know, any better. But we can handle it. It's an American problem, and they're going to have to fix it, but we can handle it. They didn't realize this is going to create a massive contraction of global, or well, at least advanced economy. So we've got to use all the tools. They underestimated it. And if you can remember in the spring of 2008, after that first wave and before Bear Stearns, I remember being at a conference in London at the LSE, where all the people that we know were there, and there was a tone of complacency. The people who were on the platform were people from, Deutsche Bank and Barclays and the Swiss National Bank, and everything was, okay. And we did very well in controlling the situation, and there are little pockets of difficulty. So I think that it wasn't just the separation principle. It was a failure to realize that we're in big soup here and central banks need to act to do something about it.
Jacob, do you want to add?
No, I mean, I totally agree with that. I mean, fundamentally, the political space, even for the ECB to begin to do more than just lower and raise interest rates, only became clear when this became about the survival of the euro, which arguably, I would say, first kicked in as late as late 2011 when the first 4-year TLTROs was announced. And then subsequently, of course, you had other things.
I think that's absolutely right. And I think it's because at that stage, it was the access of the big European banks to the New York market. They said they can't even our biggest banks cannot access the New York market. Whereas the previous situations, Greece, well, Ireland, they messed up. Portugal is the same story. These countries were countries that were delinquent relative to a standard which everybody should be able to reach. That was the thinking about it, not realizing that everything was linked together.
I am enlightened by the insights, but not exactly reassured for our future. Thank you very much, Jacob Funk Kirkegaard, and especially thanks to our colleague Patrick Honohan, former governor of the Central Bank of the Republic of Ireland.